For years, China has made public gestures about moving away from pegging its currency so closely to the movements of the US dollar. Likewise, leaders in several large emerging markets around the world have discussed creating their own currency to compete against the greenback. And of course, there's ongoing debate in the Eurozone about whether the euro will stand the test of time, both economically as well as politically. Well, with all this seemingly lack of clarity swirling in global currency markets, we thought it might be a good idea to check in with researchers at Dimensional Fund Advisors. Today, we're fortunate to have with us Michael Humbert, a DFA investment strategist. Hi, Michael. Thanks for taking the time today to discuss this important topic.
Thanks for having me, Murray.
Sure. The US dollar, of course, is the currency that we as Americans are most concerned about. But let's start by explaining how that works from a practical standpoint for an IFA investor.
Yeah, I think that's a great starting point. For dimensional funds, our opportunity set is global. So we have US investors and they want to invest in foreign assets to improve diversification and help improve the reliability of outcomes. And so when we go out and to invest in local markets, to invest in the UK, to invest in Japan or Brazil, anywhere outside of the US, we're going to do so on local dollar terms. That means that the currency return is a component of your experience over the short and over the long term. But we observe that many investors.
So your funds are buying stocks and bonds, any securities in the local markets at the local rates, correct?
That's exactly right. When we go out and engage with those markets, we do so on the local currency basis broadly.
Okay, but then you buy it back in dollars for investor returns, correct, in the US?
For the US investor, your NAV is expressed in dollars, your return is expressed in dollars. That is what you care about. Absolutely.
So once they purchase the security in local dollars, then they convert it into dollars, US dollars?
When we go out and engage with the market, we'll go out and engage in FX. If we want to do a little buying or selling, we'll do so at those prevailing rates. We'll engage with the securities that we want to add or remove from the portfolio. And then when we want to bring those dollars back to the country to meet redemptions, client cash flows, whatever it might be, we're going to again engage with the FX market at that time to bring them back. Many investors.
And I was just going to ask you, Michael, excuse me, but why do you do that? Why don't you just, keep it in local currency?
If I want to, if I have to meet client cash flows and they are asking for dollars, I owe them dollars. They gave me dollars. I have to give them dollars back. And to deliver that global opportunity set, I have to engage with those local markets and participate in the FX market as such. The question really isn't why do we do that? It's in terms of for the investor's experience, many investors are concerned about the volatility of currencies, all this noise, the swirling that you referred to, all that lack of clarity. They like to, there is a small preference for investors to hedge that currency exposure back to their home currency, back to the dollar in this case. Okay. That only really works.
The dollar is more stable over time, then that actually lowers the volatility for investors in the US, correct?
It only works to hedge back it only get a volatility reduction when you hedge back if the underlying asset itself has low volatility. Mm-hmm. In this case, your underlying asset is still foreign equities, and the volatility of equities swamps that of the volatility of currencies. You are investing in a volatile asset class in terms when you invest in foreign equities. Just equities broadly are a volatile asset class. You don't get a meaningful reduction in that volatility by hedging back to your home currency, in this case, the US dollar. So our equity strategies are broadly unhedged when we go out and invest in that local currency, when we invest in those foreign markets. In contrast, our fixed income strategies are hedged because the volatility of the underlying asset, those fixed income securities, is much lower than that of the currency volatility. So we go out and we hedge those fixed income strategies, obtain that meaningful reduction in volatility because that is what investors expect and benefit from.
Interesting. Should investors be worried about the US dollar being unseated, being devalued against other major currencies?
The question comes up with some regularity. It seems that every few years we're having this debate. Let's set up a framework to think about this problem. And let's operate under the evergreen principle that we operate that is a core to our foundation at Dimensional. Prices quickly incorporate information about future expected returns. Changes in global currency reserves are exactly the type of information we would expect to be quickly and efficiently incorporated into prices. This is a slow moving and typically lagging economic variable. It's a type of information that prices do very well with.
Even in foreign markets.
So even in foreign markets, those changes in global reserve currencies, the reserve currencies that are held by countries, so the share of a country's holding of dollars, this is a slow moving variable. They don't jump around and change over time. The share of global currency reserve for the US dollar as a global currency reserve is about 60%. And that has been that way for quite some time. It is a pretty sticky number.
Hmm. Well, you read news headlines, major financial publications around the world, the impression might be much different.
Absolutely. The task of unseating the dollar as the global reserve currency, though, is enormous. It is the most liquid and traded and stable currency in the world by a wide margin, even between two developed, highly liquid currencies like a UK, like the UK pound and the Swiss franc. It can be more cost effective to trade, to convert one to the other via a USD leg of that trade, converting one to USD and then back into the other than it is to trade them directly. The U.S. currency is one of the most liquid currencies in the world and most freely traded currencies in the world. But beyond just that, the U.S. consumer, the economy, the rule of law, all of this feeds into the dollar's role as the global reserve currency, which it has held for decades at this point. There's an inertia effect as well. All of this contributes to the enormous task of unseating the dollar as the global reserve currency.
Okay. I guess the structure of global markets and how prices work in free markets just plays right into the dollar strengths.
Absolutely. And let's think about what would happen even if I offered you, Murray, a bit of clairvoyance and I guaranteed you a piece of information that the US dollar would be usurped. What information do you need to make a meaningful investment decision, even if I guaranteed you that piece of information? You wouldn't know the depth and tenor of that transition. You wouldn't know the next dominant global reserve currency. You wouldn't understand the dollar's new role in the global reserve in terms of global trade and the global order. You wouldn't understand maybe the function of digital currencies going forward. There would still be so much uncertainty, even if offered you a piece of clairvoyance, a piece of certainty about the dollar status going forward, that you wouldn't have enough information to make meaningful investment decisions.
Sure. So trying to outguess currency markets is just as difficult as stock or bond markets.
Currencies are volatile in the short term, they're volatile in the long term. And if I look at a basket of returns, a basket of currencies, the return to a basket of currencies, it's not distinguishable from zero over the long term. So I think I'd summarize it all by saying the outcome for the dollar as a US reserve, as a global reserve currency, the outcomes for that are highly uncertain and the timeline is really long dated. It informs me there's not a lot that I can do with that information to make investment decisions today. Better to rely on what I know about expected returns, what I know about the benefits of diversification, and what I know about improving the reliability of outcomes than to try and time these structural changes in the global economy.
Okay. Thank you very much for your time today, Michael.
Thank you, Murray.